Survival is the first rule of speculation, and everything else comes after it, whether a man likes it or not. The market does not care how smart you are, how confident you feel, or how certain your opinion seems. It only cares whether you are still standing when the next opportunity appears. Most men enter speculation thinking about profits first, but profits are a luxury reserved for those who have already learned how not to be destroyed. I learned this lesson slowly, painfully, and at great expense. Every time I ignored survival, the market reminded me who was in control. One oversized trade can undo years of correct thinking. One moment of impatience can erase months of discipline. The market does not need many chances to ruin a man, it only needs one. That is why survival is not a tactic or a suggestion, it is the foundation. Without it, no method works, no insight matters, and no experience can save you. When a trader risks too much, he surrenders his freedom. He can no longer think clearly, wait calmly, or accept being wrong. His position owns him. Survival demands that risk must always be small enough to allow mistakes, because mistakes are unavoidable. Even the best judgments fail. Even the clearest trends reverse. The difference between the man who lasts and the man who vanishes is not accuracy, it is tolerance for error. Survival means accepting that you will be wrong often, and structuring your actions so those wrongs never become fatal. It means choosing to stay in the game rather than trying to win it all at once. I learned that the market offers endless opportunities, but only to those who are alive to see them. Missing one trade is irrelevant. Missing the future because of one reckless decision is unforgivable. Survival turns trading into a series of controlled experiments rather than emotional gambles. It removes urgency and replaces it with patience. When survival is respected, fear diminishes because no single outcome can threaten existence. That calm state is where good decisions are made. The market rewards calm thinking, not desperation. Every great run I ever had came after long periods of restraint. I stayed small, protected capital, and waited. Others around me chased excitement and disappeared one by one. They believed the market was about courage. I learned it was about endurance. Survival does not feel heroic. It feels boring, cautious, and sometimes frustrating. But boredom never wiped out an account. Impatience did. The market is not conquered. It is endured. Survival keeps you humble, alert, and flexible. It allows you to adapt when conditions change instead of being crushed by them. Once you truly accept that survival is the first rule, everything else falls into place naturally. Position size shrinks, discipline strengthens, and confidence becomes quiet. From that foundation, profits can grow. Without it, nothing grows at all. Size determines behavior more than analysis, and this truth took longer to accept than any lesson about charts or price. A man may believe he is rational, disciplined, and patient, but all of that vanishes the moment his position becomes too large. The mind changes when the risk becomes personal. What looked like a well-reasoned idea turns into something that must be defended. The trader stops observing and starts arguing with the market. He no longer listens to price, he listens to his fear. That transformation does not come from poor analysis. It comes from size. When a position is small, the mind is free. A trader can wait, exit, or reverse without emotional resistance. Being wrong feels acceptable. Losses are information, not threats. But when size increases beyond comfort, every tick carries weight. The screen becomes louder, minor fluctuations feel dangerous. Logic is replaced by urgency. This is why so many intelligent traders fail despite being correct more often than not. Their behavior collapses under the pressure of excessive exposure. Large size creates a dangerous illusion of commitment. The trader believes that because he has committed more capital, the trade must work. He confuses conviction with probability. In reality, probability is indifferent to commitment. The market does not reward belief. It responds only to supply and demand. Size forces a trader to care about outcomes instead of process. And once that happens, discipline erodes quietly but steadily. I noticed that my worst decisions were never made before entering a trade. They were made after I was already in, and oversized. I moved exits. I ignored signals. I waited for hope instead of confirmation. None of this came from ignorance. It came from exposure. The market did not change. I did. Proper size keeps behavior aligned with intention. It allows a trader to act according to his plan instead of reacting to fear. The plan only works when the mind is calm, and the mind is calm only when the risk is tolerable. A strategy that works on paper fails in PR. Practice, if size, destroys emotional balance. This is why risk control is not a technical detail. It is psychological protection. Over time, I learned that reducing size improved my results more than improving my analysis. My thinking became clearer, my exits became cleaner, my patience increased, the market felt slower, more readable. Nothing about price had changed, only my exposure had. The market punishes men who believe they can outthink risk. Intelligence without restraint is a liability. True skill lies in structuring size so that behavior remains stable under uncertainty. When size is right, discipline is natural. When size is wrong, discipline is impossible. Ego grows faster than capital when it is left unchecked, and the market has a ruthless way of exposing that imbalance. A few winning trades can convince a man that he is exceptional, that he sees what others cannot, that he has earned the right to take greater risks. Confidence quietly turns into arrogance, and caution begins to feel unnecessary. This is the moment when most traders start moving away from survival and toward self-destruction. The market does not punish confidence. It punishes the belief that confidence deserves exemption from risk. Ego demands recognition. It wants proof. It wants to be rewarded quickly and publicly. In trading, that desire shows itself through larger positions, faster decisions, and a refusal to accept small losses. A trader driven by ego does not trade to make money. He trades to be right. He measures success by how impressive the result looks, instead of how sustainable the process is. That mindset creates pressure, and pressure invites mistakes. I learned that the market is not impressed by boldness. It does not respond to pride or ambition. It responds to discipline and humility. The moment I felt the urge to increase size simply because I had been winning, I was already losing control. Wins did not make me smarter. They only tested my restraint. The market gives successes early to see what you will do with it. Most men fail that test. Ego also hates small profits. It considers them unworthy of attention. It pushes a trader to hold longer than necessary. Squeeze more out of a move to turn a good trade into a great one. In doing so, it often turns a great trade into a loss. The market has no obligation to satisfy pride. It moves when it moves, and it stops when it stops. A trader who cannot accept enough will never have enough. The most dangerous form of ego appears after recovery. When a man digs himself out of a loss, he begins to feel invincible. He forgets the pain that taught him restraint. He believes he has mastered the market rather than survived it. That belief is temporary, and the market corrects it without warning. I found that progress only became consistent when I separated self-worth from results. A loss did not mean failure, and a win did not mean superiority. They were outcomes, not identities. When ego loosened its grip, patience returned. Decisions became quieter. There was no need to prove anything to the market or to myself. The market offers endless opportunities to those who approach it with humility. Ego demands immediate validation and usually pays for it dearly. Capital grows slowly. Ego grows quickly. If ego is not kept smaller than capital, it will consume it. Consistency is built through restraint, not brilliance. And this truth contradicts what most people want to believe. Men admire intelligence, cleverness, and bold ideas, but the market does not reward those qualities on their own. It rewards behavior that can be repeated under pressure. Brilliance is occasional. Restraint is constant. A trader who relies on moments of insight will experience moments of success, but a trader who relies on discipline will experience survival, and survival is what allows success to compound. I once believed that if I could just think better, analyze deeper, or see faster, consistency would follow. Instead, what I found was that my best ideas often produced my worst results because I lacked restraint. I knew when to act, but I did not know when not to. The market offers opportunities every day, but it does not require participation every day. Learning to stand aside was harder than learning to enter. Restraint means refusing trades that look good but do not meet strict conditions. It means reducing size when conditions are unclear instead of forcing confidence. It means accepting that inactivity is sometimes the most profitable position. These actions do not feel productive, they feel passive. But they are the very behaviors that protect capital during uncertain periods. Brilliance creates spikes in performance. Restraint smooths them. The market punishes volatility in behavior just as it punishes volatility in price. A trader who oscillates between aggression and fear will experience uneven results no matter how skilled he is. Consistency requires emotional stability, and emotional stability comes from knowing that no single decision can cause serious harm. I learned that the market does not demand perfection, it demands reliability. A method that works half the time can be profitable if applied consistently with controlled risk. A perfect method applied inconsistently will fail. Restraint allows a trader to follow his own rules even when emotion tempts him to break them. It is easier to obey rules when the consequences of failure are limited. Over time, restraint becomes confidence. Not loud confidence, but quiet certainty. The trader no longer needs excitement or validation. He measures success by adherence to process rather than by immediate results. Losses become manageable. Gains accumulate naturally. The account grows not because of genius, but because of stability. The market is full of brilliant men who could not restrain themselves. It is also full of ordinary men who learn to survive. Consistency belongs to the latter. It is earned slowly, through decisions that look impressive but always protect the future. The market punishes excess before it rewards skill, and this lesson is written into every chart, every collapse, and every forgotten account. Skill is subtle. It develops slowly and shows itself over time. Excess is loud. It announces itself through oversized positions, rapid decisions, and an impatience that refuses to wait for confirmation. The market has no tolerance for excess because excess ignores uncertainty, and uncertainty is the only constant in speculation. I watched many capable traders fail not because they lacked understanding, but because they demanded too much from the market too quickly. They tried to compress time. They wanted large returns immediately. They believed that effort and desire could accelerate outcomes. The market does not operate on personal timelines. It moves according to forces far larger than any individual. When a trader tries to force results, he steps out of alignment with reality. Excess shows itself most clearly after success. A run of profitable trades creates the illusion that conditions will continue. Size increases, risk expands, rules soften. The trader feels justified because results appear to confirm his actions. But the market is not confirming skill. It is testing restraint. When conditions shift, as they always do, excess becomes exposed. What once seemed bold suddenly appears reckless. The market allows excess just long enough to make it dangerous. It gives small rewards to encourage repetition, then removes them without warning. This is why collapses often follow periods of confidence rather than fear. Excess blinds a trader to warning signs. He stops respecting risk because risk has not shown itself recently. That absence is temporary. Skill survives because it is conservative. It assumes uncertainty even during favorable conditions. A skilled trader expects reversals. He plans for them. He does not rely on perfect timing or flawless execution. He relies on control. Excess relies on continuation. Skill relies on protection. I learned that reducing exposure during good times was more important than increasing it. Anyone can be cautious when losses occur. Few can remain cautious while winning. That is when excess feels justified and restraint feels unnecessary. The market corrects that thinking without sympathy. Excess is not limited to size. It appears in overtrading, overconfidence, and overanalysis. It pushes a trader to act when waiting would be wiser. The market punishes this behavior because it disrupts balance. Skill seeks balance. Excess seeks dominance. Those who survive understand that the market does not reward aggression. It rewards respect. Skill grows quietly under restraint. Excess demands immediate results and pays the price for its impatience. The market always settles the difference as small losses are the cost of staying in the game, and no trader escapes that reality, no matter how experienced or disciplined he becomes. The market does not offer participation without payment. Every position carries risk, and every risk carries the possibility of loss. The mistake most men make is not losing money, but believing they should not have to. That belief turns ordinary losses into emotional battles, and emotional battles are always expensive. I learned that losses are not the enemy. Refusal to accept them is. A small loss taken early is information. A small loss ignored becomes damage. A trader who cannot tolerate small losses will inevitably tolerate large ones, because the market decides the size of losses when discipline fails. Losses do not grow suddenly. They grow because they are allowed to. When a trade moves against you, the market is offering a choice. You can pay a small, controlled fee and remain flexible, or you can refuse the payment and surrender control. Most traders choose the second option without realizing it. They wait, hope, justify, and explain. What begins as a manageable setback becomes a THR. Eat, then a crisis. The market does not cause this escalation. The trader does. Small losses preserve mental clarity. They keep emotions contained. They allow the trader to return to observation instead of defense. When losses are accepted quickly, confidence remains intact. When losses are resisted, confidence erodes. A trader who carries large losses also carries fear, and fear distorts judgment long after the position is gone. I found that the best periods of performance followed strings of small losses. Those losses kept me alert. They reminded me that uncertainty was present. They prevented complacency. Winning streaks can be dangerous because they dull awareness. Losses sharpen it. In that sense, small losses are not setbacks, they are protection. The market rewards those who treat losses as routine expenses rather than personal failures. A business owner does not shut down because of operating costs. A trader should not abandon discipline because of losses. The goal is not to eliminate losses. The goal is to control them so they never threaten survival. Small losses also protect time. Capital can recover, but time cannot. One large loss consumes months of effort, focus, and emotional energy. Many traders never recover from the psychological impact of a major drawdown. Small losses prevent that damage. They keep progress intact even when conditions are unfavorable. The market does not respect stubbornness. It respects adaptability. Small losses make adaptation possible. They allow a trader to step aside, reassess, and return when conditions improve. A trader who refuses small losses is eventually forced into inactivity by larger ones. Staying in the game is the real achievement. Profits come and go, but survival is permanent. Small losses are the admission price. Those who pay it calmly earn the right to continue. Those who refuse eventually lose everything else.